Some market participants describe the events of the third quarter of 2022 as global mayhem, and they are not far off the mark. The equity markets in the US and Europe fell strongly in September as negative sentiment continued to dominate. In the US, the impact of aggressive tightening by the Fed was strongly felt by the markets, to the extent that quite a few analysts believe that the Fed is arguably overreacting and that the reactions may significantly damage growth prospects in the near to medium future. In the United States, GDP growth was negative for a second consecutive quarter, placing this economy firmly in a technical recession. In its reaction, the White House, no doubt aware of the role the economy is going to play in the midterm elections, has pushed back against calling the current situation a recession. President Biden cited record job growth and foreign business investment as signs of strength in the economy. That doesn't sound like a recession to me, he concluded. In Europe, the energy crisis remains the key concern, with gas prices jumping again on the news of damage to the Nord Stream pipelines, which is now widely accepted to be the result of deliberate sabotage, which almost guarantees that gas supply from Russia is going to remain shut off for a considerable period yet. In the US, the S&P 500 and the Nasdaq 100 dropped significantly, returning 9.3% negative and 10.6% negative in the month, while the Dow Jones returned minus 8.8% in the month. The year-to-date returns for these indices are now S&P 500 minus 24.8%, the Nasdaq 100 minus 32.8%, and the Dow Jones minus 20.9%. The VIX, the globally accepted measure of market volatility, increased further to end the month at 22.2% higher. This index is up 83% year-to-date. European markets declined too. At the end of the quarter, the German DAX was down 23.7% year-to-date. The French CAC 40 dropped by 19.4% year-to-date, and the Euro Stoxx 50 returned minus 21% year-to-date. In addition, the FTSE 100's return year-to-date was minus 6.6%. According to Bloomberg data, non-residents remained net sellers of South African equities in September, but at an accelerated pace as 20.8 billion rand of outflows were recorded, bringing the cumulative market outflow for the last 12 months to 122.5 billion rand. The JSE capped SWIX generated a return of minus 3.84% in the month, bringing the total year-to-date return to minus 6.96%, and the return for the last 12 months to a paltry 1.12%. Total returns for South African equities were also negative as the global mayhem and persistent local electricity cuts, with no end in sight, took their toll. The rand weakened 5.56% against the rampant dollar during the month, and 19.46% during the 12 months to September. The third consecutive 75 basis points hike reaffirmed the Federal Reserve's commitment to continue to fight inflation, despite downward revisions to growth expectations in 22 and 23, and upward revisions to core PCE inflation and the unemployment rate. The 10-year generic US yield jumped 64 basis points to 3.83% at month end, bringing the total increase this year to 232 basis points. The UK 10-year generic yield shot up 129 basis points during the month to 4.08%, after the Bank of England intervened to stabilize the gilt market following the chaos caused by the new government's proposed mini-budget. In the South African bond market, non-residents were net sellers yet again, with a 21.9 billion rand outflow in September notably higher than August's 8.9 billion rand, according to Bloomberg data. This brings the cumulative outflow for the last 12 months to 291.1 billion rand. Given this universally gloomy scenario, it's not surprising that our portfolios have produced negative returns for the quarter. As an example, for our flagship Enhanced range, the more conservative Enhanced 4 portfolio produced minus 2.47%, and the more aggressive Enhanced 7 produced minus 3.54%. Underlying short-term building block returns in equity and fixed interest were also negative, confirming the widespread uncertainty in the market. However, we believe that at this time like these, that the benefits of our unique outcome-based investment philosophy are most apparent. strongly diversified, risk-controlled portfolios, remaining invested with the assets of clients, and no decisions taken as a result of panicked reactions. Over the longer term, we will continue to keep our clients' clearly defined investment goals in sight and always invest steadily and predictably. Please contact me or any of my colleagues in the Momentum Investments team if you require any additional information. Thank you.